Now, I have a question for you, and I'll lead you to your presentation. Who is the target audience for the kind of portfolio you manage?
Well, we have a very conservative investment management style. As you mentioned, capital protection is probably our paramount importance. We also try and generate a lot of tax-effective income. It's mostly dividend income. So our obvious constituency is aging baby boomers and retired Canadians. More recently, big buyers of dividend stocks and using a dividend-driven strategy have been the pension funds. Historically, they haven't cared about income because pension funds are tax-free. They had the attitude that we can get enough income in our portfolios from our fixed income holdings, and we'll go strictly for capital appreciation in our equities. What's happened, as Sandy pointed out, interest rates aren't 6 or 7% anymore. We're under 2% on 10-year Canadas. So pension funds are adopting more total return approach to the market. So there's some big new buyers coming in to buy these kind of stocks. But for all of us in this room, I think I'm looking at our core constituency. It is boomers who need tax-effective income, don't want to take on a lot of risk, but they need some capital appreciation because they don't want to outlive their capital. I'm going to go through a series of graphs pretty quickly. I'd like to convince you of one thing, and that is dividends are a lot more important than you think. And I'll tell you how we go about our equity income approach, how we capture upfront yield, and also talk about when our strategy doesn't work, what can happen, and how we adjust to it when our style is out of favor. Hopefully I'll have time to talk about our outlook for the capital markets. I think we're going to have some nervous, choppy markets for a couple of more months, but I think as we move into the fall, we're set up for a pretty good rally. Finally, time permitting, I'll talk about our portfolio strategy, what we're buying and what we're selling. That might have to wait till a cocktail party, but I'll try and squeeze it in going through the presentation. Like Century Select, we believe in a team system at Guardian. I've been there for 25 years. My colleagues, Michelle Robitaille and Kevin Hall, have been on board for about 10 or 12 years. We've had no turnover in our team. We haven't changed our style. We haven't changed our discipline. We also have three other members. There's basically 3 portfolio managers, 2 analysts, and a full-time trader, over 100 years of experience. So our returns have been pretty respectable, and it has everything to do with the team that's on board at Guardian. Quick commercial for Guardian. Guardian is celebrating its 50th anniversary. It came public in 1969. We're listed on the TSX. And what is significant about Guardian, tiny little company, we have over $300 million of cash on our balance sheet. I mentioned a key point is dividends are a lot more important than you think. I'm going to come initially at this assertion by looking at historical returns in Canada and in foreign markets. This is a time-tested strategy that's worked in all the major capital markets. And the basic message is that companies that pay stocks and pay dividends and increase their dividends outperform the index pretty dramatically. Before we get rolling, for those of you that are new to investing, one of the few tax breaks that we get in Canada is a dividend tax credit. And this is an important element of dividend investing. Dividends are taxed in every province significantly less than interest income. In BC, if you're getting interest income, tax rate is 44%. If you're getting dividend income, tax rate's about 26%. So think about income investing the same way you look at your paycheck. It's really nice to have a big gross income, healthy top line, but what's really important is what's left over after you've paid your taxes. So dividends are very tax friendly. In most provinces, you need between $130 and $135 to get the same after-tax income as $100 of dividends. Let's look at the case for dividends. This is looking at 9 major markets over a 30-year period. And the dark bar, the blue bar, is the returns from dividend income in these markets. The beige line is capital appreciation. And the bottom line, if you look at these 9 major economies, 9 major stock markets, all different cycles through a 30-year period, the bottom line is that approximately 63% of the income, 63% of the returns have come from dividend income rather than capital gains. Let's move a little closer to home. This is 40 years of history in the Standard & Poor's 500. The red line in the bottom, at the bottom of this graphic, a little hard to pick up, but it represents non-dividend paying stocks in the S&P 500. Average annualized return for the non-dividend payers is a little less than 2%. It's actually 1.7%. So if you invested in non-dividend paying stocks, your results have been terrible. If you look at the dividend paying stocks in the Standard & Poor's 500, they've given you a return of pretty close to 9%. Non-dividend payers, about 2%. Dividend payers, about 9%. And this is 40 years of history. Let's take a look at the Canadian market. This is 25 years of history. The TSX, the powder blue bar in the middle, shows that returns on the index, TSX composite, have been a little less than 7%, 6.6%. But again, if you only bought the stocks in this index that paid dividends, your returns will move up to 10%. So you can increase your return from the index by avoiding non-dividend paying stocks and concentrating on dividend payers. You can take this one step forward. Sandy mentioned the dividend aristocrats. This is an index put out by the TSX Index Committee, and it includes stocks that have increased their dividends every year for at least 5 consecutive years. Now, it'd be nice if we look at the returns from dividend growth stocks and say, let's just invest in those stocks and don't do anything else. The problem is there's only a total of 61 dividend growth stocks in the index. And it's hard to get a lot of diversification in your portfolio if you just buy that one index. Let's take a quick look at the other side of this equation. The KOD, the kiss of death in this style of money management, is earning a stock that cuts its dividend. Those stocks give you a return of about half of what you get from an index fund. And for those stocks that don't pay any dividends, over the last 25 years, you've been looking at an annualized rate of return of just a little over 1%. So in our funds that we manage, we only buy stocks that pay dividends, and we try and include as many dividend growth stocks that we can that are reasonably priced. Dividends are about as close as you can get to inside information. When a company says, we're going to increase our dividend, they're telling you that their balance sheets are in good shape, their business is growing, and they expect that to continue. Usually when companies say they're going to increase their dividends, you can look forward to positive earnings momentum. There's a very high correlation between companies that are growing their earnings strongly and stock market performers. So a lot of these stocks can become triple plays. They're growing their dividends, their earnings are going up, and investors love that, so you get a third element, and that's multiple expansion. So these can be extremely good stocks over long periods of time. Most of them are just kind of go along for 12, 15, 18 months, and you get a dividend bump. But if you get a few that are reasonably priced and are growing their dividend consistently, you're in pretty good shape. What we try and do in our portfolios, we're like most managers, would like to get returns somewhere between 8 and 10%. That might seem a little bit optimistic, but what we try and do is get our portfolios yielding between 4 and 5%. So before you start the year, you know you have 4 to 5% of income coming into the portfolio. That takes a lot of pressure off of us as managers to reach or be aggressive in trying to get capital gains. If we can buy the high quality stocks, go up 4, 5, 6% a year, we're going to have some pretty good years. This is what our portfolio looks like, and an old adage is go fishing where the fish are. I'm sure there's a lot of fishermen in the room. And they know that you can be the best fisherman in the world, but if you're not dropping your line in a good fishing hole, you're not going to catch any fish. So in putting our portfolios together, going from left to right, first element of putting them together is get the yield between 4 and 5%, and concentrate, secondly, on dividend-paying stocks and dividend growth stocks. Now, I was stuck in a second or third element into the equation here, and that's real estate investment trust. In most of our mandates, we will have, and have had the last 10 years, between 20 and 30% represented in real estate investment trust. We consider them to be the best income vehicles in Canada. This is a look back to 1998. You've got 13 or 14 years of history. This graphic will take you right up to the end of the first quarter of this year. Blue line on top is the total return from real estate investment trust versus the financial services index. Now, we think REITs are going to continue to outperform, but one of the reasons why we have a big representation in REITs is that we don't want to look like other equity income funds. And I think most investors, including myself, are up to here in banks and insurance stocks. We don't need any more funds that are overweighted in those two sectors. I'm not saying we don't have any banks in the portfolio. TD right now is our biggest holding in all of our mandates. We'll usually have some Royal Bank as well. But we think REITs are just classic income stocks in Canada. Again, they're paying about a 5.5% yield up front. That's exactly what we want. And they tend to grow very predictably. Their cash flows about 4 or 5% per year. What can kill real estate? Just as an aside, real estate is a commodity. What kills commodities is too much supply. In Canada right now, we have the opposite problem, if you call it a problem. There isn't enough capacity in a lot of sectors of the real estate business. If you're looking at retailing, most of the retail REITs have occupancy rates between 96 and 98%. Not much room for new tenants to move in, but we know there's at least 12 U.S. retailers that want to come to Canada. What's their problem? Trying to find some space coast to coast. If you look at apartment rates, many places in Eastern Canada, including Toronto, we've had rent controls. We haven't built an apartment building in Toronto for 10 years. What's the occupancy rate in apartments? 98, 99%. That is making apartments a nice place to put money in, because full occupancy rates and rents moving up is a pretty good combination in this part of the market. There are very few parts of the real estate market in Canada that are not doing very well right now. One deal this week that I think caught everyone's attention was two real estate investment companies, H&R and Dundee, buying one full block of the Bank of Nova Scotia's real estate on King Street. If you know Toronto, between Bay Street and King, all those properties on the south side are owned by the Scotia Bank. That sale by the Scotia Bank was for $1.3 billion. In about 10 minutes, a $400 million deal by Dundee to raise equity was completed. H&R balance sheet was in terrific shape. They didn't raise any equity, but they were able to borrow $650 million at less than 3.5%. Pretty darn good. So a lot of good things happening in real estate that we haven't seen in the past, and spend a little bit of time on that because one of the quirks of our strategy is that we do have very good representation in the Real Estate Investment Trust. I'm going to spend a minute on this graphic because I really disagree with the idea that buy and hold doesn't work in Canada. A lot of people are saying, gee, you just got to trade this market really aggressively. There's no point to being a buy and hold investor. I think if you look at the numbers in Canada, they're very much different than they are in the United States. And that's because Canada is very much different than the U.S. I'll bet you that most people in this room spend far too much time watching Bloomberg, CNBC, and ROB TV, and associate the problems in the United States with what's going on in Canada. We know in the United States there's like a perpetual election machine, all sorts of political turmoil. Canada, we have a majority government. In the U.S., individuals hate their banks, hate their brokers. In Canada, we have a tremendous financial system. We have natural resources, we have a strong currency, our social welfare programs are funded, and our retirement benefit plans are in great shape, not so south of the border. So let's look at what that's resulted in. We all know that if you're going to be in the stock market, you have to have at least a 3 to 5 year time horizon. Just for the sake of time, let's just work our way around this graphic in a counterclockwise manner. If you look at the the S&P TSX Composite, 10-year rate of return of 7.3%. The last year hasn't been a lot of fun. We've gone through a normal correction consolidation. But if you're strong enough to have held stocks through 2008, you're looking at a 3-year return that's pretty close to 27%. So if you look at those returns from the index in Canada, they're pretty respectable numbers. How could you have done better? We think if you have played and continue to play dividend-paying stocks, you're looking at a 10-year return in the mirror, retrospectively, of over 10%. And the dividend payers, 5-year return about 6%. Let's move over to the REITs. Hasn't exactly been a lost decade if you've been an investor in real estate investment trusts in Canada. 10-year return about 12.5%. 3 years, 37%. Even year to date, the TSX is down about 3% as we sit here this morning. REITs are up about 8%. Finally, if you look at the dividend growers, again, some pretty healthy numbers. Looking at 10-year, 9.6%, year-to-date returns of about 6.1%. So I think Canadian market, if you're dividend-oriented, if you're a conservative investor, makes a lot of sense to be a buy and hold investor. Let's shift gears a little bit and talk a little bit about the capital markets. I think I can get through this fairly quickly because our overview is not a lot different than Century Select. We think we're living in an era of deleveraging, and what that will bring about is slow growth, low inflation, and low interest rates. I think that's what's ahead of us for the next 4 or 5 years. If we can get returns 7 or 8% for the stock market, that's going to be terrific. When you look at the U.S. economy, which kind of sets the tone for North America, for most of the last 15 years, it's been growing about 4%. If you go back further than that, the long-term growth rate for the U.S. is about 3%. What caused that extra 1% of growth? It was by individuals, governments, corporations tacking on too much debt. Now we're on the other side of the equation. Instead of looking at 3% plus 1% leveraging, we're looking at 3% minus 1% deleveraging. I mentioned that the U.S. has got a ton of problems that we don't have in Canada. One that is going to be front and center as we go into the election this fall is what has been termed the fiscal cliff, or the cliff. On January 1st of next year, there are automatic spending cuts that are going to be put in place. This includes defense, unemployment benefits, etc. On the other side of the equation, the Bush tax cuts expire at the end of this year, and we'll see dramatic increases in taxation on dividends, on capital gains. And the net of this, if this fiscal cliff isn't addressed, it'll take about 3% off growth in the first quarter of next year. We'll be staring a recession in the U.S. In the face. What's good about this is this problem has to be addressed during the presidential campaign. And we think it will be, and the market will breathe a collective sigh of relief. But the market's starting to get really worried about it. It's not just problems in Europe. There's some issues in the U.S. to address. How do we invest? How do we prepare for this? Lot of talk the last 3 or 4 years about a bond bubble. Interest rates are too low. But the truth of the matter, as long as you keep your duration or term to maturity short and you invest in high quality fixed income securities, you're going to get your coupon paid every month and you get all your money back. So as long as you're short term and stick to high quality merchandise, you'll be fine. The problem is that we're looking at interest rates in high quality government securities, let's say 10-year Canadas or 10-year Treasury bonds at interest rates below 2%. Right now, Government of Canada bonds are about 1.8%. And these are the lowest interest rates that we've seen in history of North America. I was born in 1946, so I can relate to this chart. Last time we saw rates about 1.5% was right after World War II. So when you look at what's happened the last 30 years, we've had a 30-year bull market in bonds. And this is not a low-risk entry point if you have maturities longer than 1 or 2 or 3 years. Bonds do not have a good risk-reward ratio. So that's a tough call whether you put more money in bonds right now. And looking at stocks, biggest problem we have had are valuations. During Techtopia, during the technology boom, we had multiples go up to 25 to 30 times ratios. And we've spent most of the last 10 or 12 years seeing those valuations come back to normal. If you look at where PE ratios are right now, they're pretty reasonable. 14 and a half times is a pretty good valuation on the stock market, and the stock market is discounting a lot of pessimism at the current time. So the question is, do we buy stocks or do we buy bonds? If you're looking at the bond market right now, you can buy, again, a 10-year Canada at 2%. What that means is 10 years from now, your total return will be 20% interest income. It'll be taxed at 44%. That cuts the return down pretty close to 11%, 20%. Tax gets you down to 11%. Then you got to adjust for inflation. I would suggest that you invest in a 10-year high-quality bond and you're retired, you're going to be encroaching on a lot of your capital to maintain your standard of living. This is not a good scenario being in 10-year bonds. How about investing in an index fund of the TSX for the next 10 years? You're getting a 3% plus yield up front, probably closer to 3.25. But let's call it 3%. 10 years, you'll have collected 30% of dividend income. And you'll be eligible for the dividend tax credit, so you can increase that by about a third. For stocks, not to outperform fixed income vehicles materially, you will have to see no appreciation in the market, and you will have to see no increases in dividends, which is, I think, a pretty dire scenario for stocks. So I think if you're looking at risk and return right now, stocks make a lot more sense than fixed income vehicles. If you're retired, living on investment capital, and looking out for 10 years. It's really no contest, stocks versus bonds. The question is, what's going to happen to dividends in Canada? Can managements in Canada increase their dividends? And if you look at history, this is 60 years of history, and one thing that's good about dividend-driven style in Canada is that corporations, Canadian corporations, love to pay dividends because they know Canadian investors love to get dividends. So if you look at the correlation between dividends, the red line, and corporate profits, the blue line, you can see a very tight correlation. Right now, the payout ratio for the TSX is 42.5%. Historically, it's been very close to 49%. So we think going forward, we've got a little catch-up to do in terms of dividend payouts, and this is a pretty good scenario if past is prologue and payout ratios and earnings momentum stay in place. Important to point out that corporate Canada has never been in better shape. Balance sheets are terrific. Earnings momentum is very steady at the current time. Now, we know managements can pay dividends, but will they pay dividends? There's a lot of things that corporations can do with their cash flow. What we tend to concentrate in are stocks that increase their dividends as first and foremost. If they don't do that, we like to see them pay down their debt and do share buybacks. If you can get all three of those, or 2 out of 3 elements in stocks that you're buying, you're in pretty good shape. give you an example of companies that don't do that, or sectors that don't do that. I'd take a look at the gold stocks right now. We are not big fans of the gold stocks. They've had tremendous levels of profitability the last 10 years. You can produce gold $500, $600, $700 an ounce, sell it at $1,600, $1,700 an ounce. Your profitability is just fantastic. What have the gold stocks done? The gold companies have done, have they increased dividends? A few have increased them a little bit. How much stock have they bought back? Nothing. How much have they devoted to debt reduction? Very little. What have they spent most of their time doing the last 5 years? It's using their fantastic cash flow to make expensive acquisitions in geopolitically unstable areas. So gold stocks don't fit the bill for us. Is one area that we'll stay away from. But for a lot of Canadian companies, we think they're going to continue to increase their dividends and do some paybacks. And as I mentioned, their balance sheets are already in good shape, and they'll probably continue to do it. 2 minutes? Okay, I'll go real quick. Again, this is a long-term look at dividend payouts. You can see in the recession in 2008, 2009, they came off, and now year over year we're up about 9%. We think that kind of payout will continue. How do we make money in the stock market? It's only 3 ways to do it. We can try and buy stocks and hope their multiples increase, but there's a high correlation between interest rates and multiples. I showed you that chart with PEs coming down. Hopefully they're going to stabilize. Hard to build a case for increasing multiples at the current time. How about increasing earnings? Well, again, we think we're in an era of deleveraging. When the economy is growing at 2%, it's hard to find a lot of companies that are growing their profits at 10 or 15%. So that may not work either. What's a better way to play the game? Try and get as much upfront income as you can, and accept the fact that capital appreciation is not going to be as easy to come by as it has in the past. Last graphic, and we'll open it up for some Q&A. Portfolio managers have sources of income, sources of input that the investing public really doesn't know that much about. They're portfolio managers for portfolio managers. And Ned Davis is my favorite portfolio manager. He does a lot of good stuff, but this graphic that he puts together on an ongoing basis is based on the fact that stock market cycles and economic cycles tend to repeat themselves. So what this forecast, or this roadmap for the market does, it looks at a 10-year cycle, a decennial cycle, looks at a 4-year presidential cycle, and it looks at a 1-year seasonal cycle, and integrates them. Over 10 years, each of the 10 years has a different economic and stock market personality. 4-year presidential cycle, the same thing. I think on a seasonal basis, we all know sell them and go away and try and reposition your portfolio in the fall. If you look at last year in August, this called for an exit out of the market. A re-entry point in the fall, a strong rally through year end, and then a steep correction right through the summertime. Taking this forward a little bit, we think we're going to have a very strong rally in the second half of the year. It's not just based on Ned Davis's input, but psychology can turn on a dime. We're going to have a debt deal in the U.S. make a world of difference at the stock market. China could start accelerating their growth. That by itself could make the Canadian market much stronger. So we can get in a positive feedback loop. Energy prices come down. Consumer has more disposable income. Inflation rates go down. Interest rates go down. Employment goes up, et cetera. So we'll leave on a happy note. I think we've got 2 or 3 months of of more wood to chop. But I think as we get into the fall, we're set up both fundamentally and technically for pretty good market action.
Do we have any questions? If people have written down questions, they can put your hand up and we can collect them. Do you recommend selling gold stocks now?
I think it's a little bit late to be doing that. They appear to be just deeply oversold and should have a bounce. But what is happening, you have that ETF effect. A lot of money went in ETF. Now it's coming out and it's really hurting gold stocks. If you like gold, buy gold bullion. Don't buy gold stocks. I think it's a lot safer bet.
John, do you recommend dividend-paying companies in the energy sector, for example, Suncor?
We have not warmed up yet to natural gas stocks. We think we're probably a year or 2 years before the price of natural gas gets back to $4 or $5. We do like oil stocks. Natural gas, I think, you put on the back burner. But we like oil stocks. They've gone through a deep correction as well. We expect oil prices to settle between $85 and $90. We're almost back in that range right now. A lot of our good oil companies, a CNQ or a Suncor, are already discounting oil prices around $70 to $75. If you look at something like Suncor, it's probably discounting $60 oil. So we think there's some real good value in Canadian oil stocks. Natural gas stocks, we're just not there yet. Well, I look around the room and I see a lot of individuals that are my age, and I can remember buying my first house and having a 9% mortgage. And when I rolled it over, it was 19.75%. And it was a real killer. And I think a lot of young kids today are leveraging themselves up because they expect interest rates to stay low forever. When interest rates mortgages go from 4% to 6%, that's a huge burden on already over indebted people. And as you're saying, a lot of people are living paycheck to paycheck.
Thank you very much.